Hi guys, in this lecture we will learn about finance and accounting second part. In this part we will learn about sales and order intake, costing, pricing, annual statement, capital and its maintenance, auditing. Sales and order intake. A sale. What is sale? A sale is a transaction between two parties where the buyer receives goods, services and assets in exchange for money. Order intake. What is order intake? Order intake is a measure of company production in terms of customer offers to buy product or services. It refers to receiving or processing a customer's order. A company's cost, its pricing and the level of overheads that it can afford all depends critically on the level of sales. Monitoring the level of sales is therefore a very important managerial activity. Costing. What is costing? The price at which an organization decides to sell a product or a service depends on the cost of producing and providing it, market conditions, price and availability of competing products, elasticity of demand. There are four elements of costing: raw material and borrowed items, cost of equipment, direct labor cost, overheads. Material, which are bought by a company and proceed as part of the company's manufacturing process, are called raw material. Bought in terms items are those items that are bought by a company and incorporated into their products as it's unchanged. The cost of equipment for a company is simply how much the company paid for the equipment. The cost of labor is the sum of all wages paid to employees. Overheads are the costs that cannot directly associated with the specific product or service but must still be covered by total revenue. Examples are marketing cost, managers cost, and costs related to preparation of bids. Departmental overheads, corporate overheads. What is departmental overheads? Departmental overheads are associated with specific parts of the organization and should be covered by the revenue and earned by those parts. Corporate overheads. Corporate overheads are associated with the whole organization. Now we will discuss about pricing. What is pricing? Pricing is a method of determining the value a producer will get in the exchange of goods and service. Simply, pricing method is used to set the price of procedures offering relevant to both the procedure and the customer. The price that a company charges for its products and services is constrained by the fact that revenue must exceed the cost of those products. Software companies are typically faced with pricing in three contexts: pricing a bid to provide services such as consultancy, design or programming with payment based on the effort supplied; pricing a bid for a contract to supply bespoke software at a fixed price; pricing a software product which they have developed. Now we will learn about annual statements. All limited companies are required to produce annual accounts and to give a copy of them to registrar of companies for filling. The company account should include the balance sheet, a profit and loss account. What is asset? A personal asset is anything that you own that has monetary value. If you own it and you can sell It is an asset. What is liability? A liability is anything that you own. Everything that you have to eventually pay back is liability. For example, a mortgage or credit card debt. That if you what is your net worth? If you would sell all your assets and use the cash you gain to pay off all of your liabilities, your net worth is what will remain. Asset and net worth formula: asset minus liability is equal to net worth. A balance sheet. What is balance sheet? A balance sheet is a snapshot of financial state of an organization at a single instant, normally at the end of an organization's financial year. It shows the values of organization's assets and its liabilities. Normally, a balance sheet also shows the 12-month previously position for comparison purpose. The name suggests a balance sheet must balance the total asset and total liability should be equal. To achieve this, balancing item is added on one side or the other. Here we can see that personal balance sheet. Next, a profit and loss account. A profit and loss account records the money received and money spent. It is also called an income and expenditure account in case of non-profit making organization. Here we can see income, expenditure, annual statement, second part of annual statement, profit and loss account. Next, capital and its maintenance. The concept of capital maintenance has important practical consequences. The capital of a company is usually taken as a guarantee that the company will be able to meet its obligations. A lender also takes into account a company's capital when deciding whether or not to give a loan. To maintain capital, a company is not allowed to issue shares at discounted value. A company cannot pay back to the shareholders any of their original contribution. Next, what is auditing? Auditing. Financial auditing is the process of examining an organization's financial records to determine if they are accurate and in accordance with any applicable rules, regulations, and law. The company account should be accompanied by an audited report. Purpose of the report is to provide members of the company and public with the assurance that accounts give a true and fair view of the state of affairs of the company. It is not predictable for auditors to check every financial transaction. They work by examining the adequacy of companies' financial procedures, making detailed checks on a small sample of transactions and assets. The primary responsibility for preventing and detecting frauds lies with the directors of the company, not with the auditors. However, auditors are also expected of finding anything seriously misleading in the financial statement. If they find evidence of fraud, they have a duty to report it to directors. Thank you.